Welcome to this video on how tough times will be for finance ministers in the Eurozone. For years the government's interest rate burden has been falling, but now Eurozone finance ministers will have to pay much higher interest rates on new government bonds. The average interest rate for all government debt will rise in the coming years when maturing bonds will be replaced by new bonds. In countries such as Italy, the average interest rate is likely to exceed nominal GDP growth in the medium term. If average interest rate payment exceed nominal GDP growth, a country like Italy needs a budget surplus before interest rate payments. Without such a primary surplus, government debt will grow faster than GDP, debt ratios will rise, which is dangerous in the long run. The zeitgeist favors big government, so finance ministers will not reduce budget deficits sufficiently. They will try to shift more government debt to the European Union level. But in the end, this will not prevent government debt to GDP ratios from continuing to rise in many Eurozone countries. And if there is another crisis, they will jump up without falling thereafter. Rising government debt ratio put pressure on the ECB to keep the monetary union together with loose monetary policy. This is one reason why we expect inflation rates to average well above the promised 2% over the coming years. But the ECB will not be able to shield finance ministers completely. There are therefore considerable upside risk, for example, to Italian government bond yields in the long term.